This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, there is just one more possible scenario in terms of dealing with the opening years of a new unincorporated trade and establishing the assessment for the relevant tax year of assessment. Up until now, what we have seen is that by year 3, we've always been able to work on a current year basis. How we've got there has always involved the first tax year of trading being assessed on an actual basis. Then the second year, that's the one that's posed us the problems. We've had to look to see, to begin with, do we have an accounting period that ends in that second tax year? The answer to that question, until now, has always been yes. Now, if you were lucky in that first situation where the answer is yes, the period of concern may have been exactly 12 months, a year. And if you had a year ended in a tax year, CYB is now able to be used, and your problems of transition from an actual basis in the first tax year, which it always is, to using CYB as soon as it is available, would be over. But more likely in an exam question, of course, we may very well see, though we do have an accounting period that ends in that second tax year, it's not 12 months. It's either short or long. And we've now seen the rules and had examples dealing with those particular issues. So what we've got to look at, as we said last time at the very end of that session, was when asking that question, do we have an accounting period that ends in the tax year? What happens if the answer is no? Now, you might not think it's possible. Well, it is. Depending on your start date, if that start date is towards the end of a tax year, you then go with a long opening period. It may well be that the first accounting period end date that you have is it actually in the third tax year. You start in the first tax year, you trade all the way through the second tax year, and it ends up being, probably early on, but in the third tax year before you have an accounting date. So that would mean that in answer to that question, the answer is no. Well, we've got to have a way of dealing with that, just in case. And it's a simple basis, because what we do is to again use, I say again, we've already used the actual basis in the first tax year, we use the actual basis here. Now in the second tax year, we've traded all the way through. Therefore, it is from the beginning of the tax year, the 6th of April, all the way through to the end of that tax year, the 5th of April. Now clearly that will mean we're taking a 12-month period out of a long opening period. So again, an apportionment to establish that assessment will be required. But what it will mean, and where I first started this discussion this time around, is whereas normally we are used to seeing that by tax year 3, we have a CYB basis of assessment in place and able to be used, that's not going to happen here. Because in the third tax year, we will indeed have an accounting period that ends in that third tax year. But it won't be a year end. It will be a long opening period. So for year 3, and it's only going to happen in this one particular situation, we would now be assessing profits for the 12 months to the accounting period end date ending in year 3, in that tax year. So in the previous session, we saw what happened if you started trading with a long opening period. And that long opening period ended in the second tax year. Which 12 months of profit would we take and assess? We would take the last 12 months of that long opening period. The 12 months to the accounting period end date ended in the second tax year. All that we're now facing is we do that, we use that basis of assessment now in the third tax year. Because we do not have any accounting date ended in year 2, we have an accounting date ended in year 3, it is a long period. Which 12 months will we assess? The 12 months to that accounting date ended in that tax year. Same concept, same principles as when we had the long period ended in the second tax year, it just now happens to be the third tax year. That would mean we'd have to wait all the way around until the fourth tax year before CYB could operate. All right, let's see how that manifests itself with a little example. Now again, I'll reserve the example in the text here for you to have a go at and for us to review. Let's therefore get pen and paper ready, and could you make a note of this little example here, please, where going back to the examples I've made up for you here, I kept on starting them on the 1st of January 2020, and we know what that meant. It meant that our first tax year was the 1920 tax year. So, taxpayer commenced trading on the 1st of January 20, our starting point in tax years of assessment 1920. And prepared accounts now to the 30th of April. But the first 30th of April we choose to prepare accounts to is the 30th of April 2021. Now, you may recall that we had an example a little while ago that, again, I gave to you on these blank pages, whereby we started on the 1st of January 2020 and we firstly prepared accounts for 9 months, and in the second example, the last we did, we went with 15 months through to the 31st of March of 2021. Now that meant that that long period ended in the 2021 tax year. But I've now traded on for just one more month to the 30th of April 21. And that date, of course, ends in 21-22, the third tax year. So we're going to have to wait all the way through until the fourth tax year before we can use CYB. Now that's easily determined by, remember what we do. We look at the start date to give us the first tax year. Then we look at our first year-end date to tell us when CYB will be available. Right, year ended 30th of April 22. Using CYB, in which tax year will we be able to use it? What accounting date do we have? Which tax year does it end in? 30th of April 22. That ends in the 22-23 tax year. So in the first year, 1920, it will be actual. In the 22-23 year, it will be CYB. So this time we've got a gap of 2 tax years to fill in, 2021 and then 21-22. Now let's see how we fill those gaps in. We've seen what the bases of assessment are. We know that in the second tax year, if as we have here, it means that that long opening period doesn't end in the second tax year. There is no accounting period in the second tax year. It ends in the third tax year, 21-22. 1920 is the first year, 2021 is the second tax year, 21-22 is the third year. And that means, therefore, for the second tax year, we'll use an actual basis, 6th of April to 5th of April. In the third tax year, we'll have to pick 12 months. It will be the 12 months to that accounting date that this time ends within the third tax year. What I want you to do first of all is what you've done all the way through. Oh, pardon me. Ooh, itchy snitchy. What you've done all the way through, and that, of course, is to deal with the first tax year on an actual basis. It doesn't change. This is an actual basis for the first year. So you know what it is. It's 1920. You know what the basis of assessment is. It's actual. You know what the period is, the basis period, 1/1/20 to the end of the tax year, 5/4/20 there. So all you've got to do is just work that figure. So work that assessment for me now. Pause if you need so to do. Get that in before we then proceed to move to the second tax year, 2021. And we should know what awaits us here, but we'll see that in a moment's time. Okay, let's see what we've got, therefore, in relation to the 1920 year. As we saw when dealing with a March accounting date and the same start date of the 1st of January 20, the number of months within the first tax year is 3. But this time, that 3 months is drawn not from an opening period as in our first example, it was 9 months, nor the second example, the previous one we did here, 15 months, but now it's a 16-month period. in which we made a profit of £48,000. Now, 16 months, 48,000, that's £3,000 a month. So 3 lots of that, 3/16 of that is going to be £9,000. Right, actual assessment as ever in the first tax year. 2021, the second tax year. Do we have an accounting period ended? No. Therefore, what do we use? An actual basis. What do we mean by that? The 6th of April at the start of the tax year, 6th of April 20, through to the 5th of April at the end of the tax year, 5th of April 21. Now something to, you didn't have to monitor it at this point, but we may as well point it out. Given that we've gone actual, we can see there that there's no overlap here between those two bases of assessment. 1st of January to 5th of April, 6th of April to following 5th of April. Those are unique basis periods. So there'll be no overlaps here at the moment. So that period of the actual tax year is 12 months. Again, it's taken from an opening period of 16 months in which we made 48,000. And that, if you want to check it through, should give you £36,000 as the assessment. On to the third year, 21-22. Now, in 21-22, as we've been saying up until now in this example, we've always been on to CYB by the third tax year. But that's not the case here. Again, as we've done before, we asked, do we have an accounting period ended in this tax year? Yes, we do. It was the opening 16-month period through to the 30th of April 21. So we take the last 12 months of that long opening period, the 12 months to the 30th of April 21, the one that ends within this tax year. What therefore would be that basis period? We'll be taking the 12 months, as we've just written, to the 30th of April 21. When would that 12-month period have begun? The 1st of May 20, therefore, is when that would have begun. It is again 12 months taken from the opening period of 16 months in which we made £48,000 of profit. The same calculation as we did in year 2, it's the same answer. £36,000 will be our assessment therefore. Now, this time, will we have any overlaps? You bet we will. Now, in 2021, we came as far as the 5th of April 21. All 21-22 has done with its 12 months is go to the 30th of April 21. Now that's in to the nearest monthly terms. That's just one more month. So 11 of the 12 months that have been assessed in 2021 are the same 11 months have been assessed within 21-22. We have 11 months of overlap. We'll come back and do that calculation of overlap profit in a moment. But let's just finish our assessments. Into 22-23, now we can use, as we identified when we looked at the information in the question itself, the year ended 30th of April 22, using CYB, assessable in 22-23. There we go. Let's get that written in there for accounting year end 30th of April 22, and I think we had some £60,000 worth of profit for that particular period. Let me just go back and check. Yeah, there we go, 60,000. Okay, now I want you again to look through what we have just done. Again, use the bases of assessment in your notes if you still need to at that point in time, if you're still having trouble memorising what these rules are. Use them until you become that familiar with them that you will remember them there for the future. And make sure we're happy with why it is, given those are the rules, that those rules mean these bases of assessment and basis periods within this particular example. Make sure you are happy with all of the numbers that you see there. And when you've done that, I'd like you to then also please compute what overlap profits have arisen. As we saw, there was no overlap between the first and second tax year, but there's a very big overlap, some 11 months worth of overlap between the second tax year, 2021, and the third tax year, 21-22. Obviously, get to 22-23, it's a new unique period. The year ended April 22, no part of which has already been assessed in an earlier tax year. So look through and work those overlap profits for me now, please. Okay, well, hopefully, therefore, you've analysed what we've done in answer to that question regarding what the rules are, put the two together, those need to be learned, and of course the way you'll do that is further practice. I also asked you to compute the overlap profit. We have determined the extent of the overlap period. We saw that in the second tax year, 2021, the 12 months we'd taken was 6th of April 20 to 5th of April 21. Then again in 21-22, we used 11 of those months because our 12 months only went as far as the 30th of April 21, just 1 month after the period that we had taken into account in dealing with the previous tax year, 2021. So we've got 11 months worth of overlap. So our overlap profit, therefore, would be computed as overlap profit 11 months of the, it wasn't 18, was it? It was 16 months opening period in which we made 48,000. 11 of those months have been common to both the second and the third tax years of assessment. That therefore means that we're talking about an overlap profit of 33,000. Remember, what do we do with that overlap profit? We note that, and when it will come into play is when dealing with cessation of trading in determining what is the assessment for the very final tax year in which we traded. We will deduct those overlap profits where, as a deduction from a profit figure, it is known as overlap relief. Those overlap profits that arise in opening years will become overlap relief to apply in the final tax year. We'll see that in a later lecture on this chapter, to be deducted in deriving the final trading income assessment for that final tax year. The other way, of course, that we could have established here what the overlaps were, we have seen that in establishing the assessments for the first 3 tax years, we have used the same profit, 48,000, 48,000, 48,000. Before moving on in the 4th year to a unique period of profit, 60,000. But the first 3 tax years have used a profit of 48,000. And what have we assessed over that period? 9,000 plus 36,000. 9 plus 36 is 45. Plus another 36. 45 plus 36 is, I think, £81,000. 81,000. Therefore, £81,000 worth of assessments based on £48,000 worth of profit made. What is that difference? £33,000 there in terms of the profit made. In terms of establishing through the calculations here of overlap relief, how many months of overlap you have, then that, you don't need to know any shortcuts or tricks about this, but what you are able to do is if you look at the accounting date that you have chosen and ask yourself, again to the nearest month, how many months is it from that accounting date through to the end of that tax year? Well, from the 30th of April 21 through to the end of, well, that's in the 21-22 tax year, that would be 11 months. So we got 11 months worth of overlap. If I take you back to the previous examples that we did, the one prior to this is when we chose March. And when we chose March as our accounting date in a very similar situation, then there were no overlap profits. How many months from the 31st of March to the next 5th of April? No months. And in our very first example, we chose 30th of September as our accounting date. And with an accounting date of the 30th of September, from the 30th of September through to the end of the tax year, well, that's 6 months worth of 6-month gap there from the accounting date to the end of the tax year. That, therefore, 3 plus 3, some 6 months worth of overlap. Of course, you then need to know what particular periods you are overlapping on to know whether you're using just one profit or, as here, 2 profits in that first example. But that's another way of working out, so how many months of overlap profit do I have? Okay, one way or another, therefore, you should be able to establish the overlap profits, doing what we have done continuously through these exercises, knowing for this tax year, this is the basis of assessment. This is how we compute that basis of assessment. In this scenario, we should now be able to work our way to any potential scenario presented to us for an opening year's problem. You, of course, need to practice this before we go any further. And as luck would have it, there is example 4 for you to have a go at. So what are the requirements here? As you might expect, compute the assessments for the relevant tax years of assessment for the information provided, and then to calculate the amount of overlap profit and to state what will happen to that overlap profit. Now, we know what happens to the overlap profit is deducted in deriving the assessment for the final tax year of assessment. The assessments on a start-up situation, standard approach, commence trading on 1st of December 19. Which tax year is that? There we go, 1920 is the first tax year. You know, the actual basis of assessment will apply from that start date, December 19, through to the end of the tax year, the 5th of April 20. We then prepared accounts to the 31st of May 21. In which tax year does that end? It ends in 21-22. It is not a year end, it is a long period, from the 1st of December 19 through to the 31st of May 21. Is that the second tax year? No. 1920 through to 21-22. We are missing, therefore, 2021. So it means there is no accounting date ending in the second tax year. That tells you, therefore, which scenario you're looking at and what basis of assessment to use. The period of profit, it's a trading profit of £54,000, and then we've got an adjusted trading profit for the accounting year ended 31st of May 22. First time you have an accounting year, first time you can use CYB. Year ended 31st of May 22. What tax year does that end in, allowing you to use CYB? That will be the 22-23 tax year. So first year actual, that year is the fourth year, CYB. In between, what are we going to do? 2021, no accounting period ending in that second tax year. That means an actual basis will apply. 21-22, we have an accounting period ending in that. It is the third tax year. It is a long period. We take the last 12 months of that particular period. Okay, over to you guys, therefore. Have a go at that, and then we'll check through quickly the answer before moving on, as you will see here, to closing year rules. But before we do that, having looked at the bases of assessment and how they apply, I'm going to set you a little planning question to do based on those opening years. So no new bases of assessment to worry about. That won't happen until we come to closing years. And that, as I've said to you before, is a much easier situation to deal with. So don't worry, it's nowhere near as long as the exercises we've just been doing. But have a go at that first of all, and then we'll play a little planning game. You're going to give me, or your client anyway, a bit of tax advice about the choice of accounting date in opening years. Again, getting again towards that tax planning style of question. Okay, work this one though as it stands, please, and then come back and we'll see whether or not we understand the answer. Hopefully the answer to that will be a resounding yes. Okay, well, let's see how you fared on this one. Again, we knew that the first tax year was 2019-20. Its basis of assessment is always actual, That always means from your start date here, the 1st of December 19, to the end of that tax year, which is the 5th of April 20. So we've got December, January, February, March. So we've got 4 months out of what then is a long opening period. And if you worked it through, that was an 18-month period. 4/18ths of 54,000 should then come to £12,000 assessment, and that's the assessment for the 1920 tax year. On to our second tax year, 2021. As we discovered in our initial analysis of the information of the question, there is no accounting period that ends in that tax year. No worries. Actual basis, start of the year, 6th of April 20, through to the end, 5th of April 21. That, of course, this time is taking 12 months, but out of the same 18-month period in which we made £54,000, and 12/18ths of 54 will therefore equal 36,000. Assessment determined. Is there any overlap in those first two tax years? No. Actual, unique basis periods. It is in this situation between the second and the third tax year that we see the larger overlap arising. What we've got, of course, in the third year, 21-22, is a long opening period ending in that third year, a period of more than 12 months. It is an 18-month period. So what do? Where we have a long period ending in the tax year, we take the last 12 months of that period, the 12 months up to that accounting period end date, which is the 31st of May 21. So as we're going to the 31st of May 21, 12 months prior to that would have begun on the 1st of June 20. It is 12 months still out of the 18-month opening period in which we made the profit of 54. So yet again, it is £36,000 that is being assessed. Do we now have an overlap period? You bet we do. In the second tax year, you'd come as far as the 5th of April 21. The third tax year, covering again a 12-month period, goes only as far as the 31st of May 21. We have got, therefore, just 2 more months of profit being brought into the assessment period. We'd come as far as the 5th of April. We therefore now go April and May through to the end of that period. Only 2 unique months, therefore 10 months of overlap. 10 months, of course, which run from, there's your 1st of June 20, there's your 5th of April 21, there is the overlap period. 1st of June 20 to 5th of April 21. That, as we've said, is 10 months out of the self-same 18-month period in which we made 54,000. So there is the £30,000. What do we do with it? As we said in our introduction, of course, that will be deducted in deriving the assessment of the final tax year of trading for the taxpayer here. In terms of overlap profit, again, different ways by which you can determine, so how many months of overlap is it? We have an accounting date of the 31st of May that we are using. We have a May accounting date. Therefore, from the 31st of May to the end of the tax year, how many months are there? There's 10 months. So there's going to be 10 months of overlap. You still need to identify which 10 months of overlap they are so that you can establish the amount of overlap profit. We've come as far as 21-22. By 22-23, we are then able to use CYB because for the very first time we have an accounting year ended in that tax year. The CYB assessment, therefore, £48,000. Okay. Hopefully, therefore, all happy with the way in which we put that computation together. Again, it is messy as opening years. Again, through generations of students, it's always been one that students don't like because it could be this, it could be that, it could be the other, and you've got to learn it. You've got to remember it, therefore. Now, as I say with so much of taxation, there's no easy way. It is just practice. If you're not willing to put the practice in, they ain't going to do it. So you've got to find the time to put that practice in so it becomes second nature. Okay. Now, I'm going to go back to the examples I gave to you, where the last 2 of the examples I've done for you and worked with you were this last one where we'd started on the 1st of January 20 and then produced a 16-month period through to the 30th of April 21. And that was, as you've just been practicing with that last example, a situation where there is no accounting period in the second tax year. You don't have an accounting period end until the third tax year. And based on the profit figures of 48,000 and 60,000, we then established what the assessments were. And that took us all the way through to 22-23, from what was again January 20 there, our 1920 first tax year of trading. Now the previous example to that was very, very similar. The only thing I've changed was the accounting date. This time it was the 30th of April, and in that 16-month period to the 30th of April 21, we made £48,000. We then had a year making £60,000. If you look back to the previous example, we again started on the 1st of January 2020. We again had a long opening period, but this time to the 31st of March. So our opening period went for the period through to the 31st of March 21. Now that one ended in 2021 tax year. When I went to April a moment ago, the 30th of April 21, that ended in the 21-22 tax year. So it gave us this different scenario, all out of just one change. Instead of preparing accounts to 31st of March, I then prepared accounts to 30th of April. Now, clearly, when you first start to trade, you have a choice of accounting date. Now, the only time this is going to be an issue is not about any random dates. It's basically about, do you choose an accounting date that falls towards the end of a tax year? There, the 31st of March is as a month end as close as you can get to the end of a tax year. Or do you choose an accounting date that ends early in the tax year? 30th of April. That's the first month end within a tax year that began on the 6th of April. Now again, you at this point, and any client would know, they don't even not too certain about which even accounting date to choose. But now, given that we have these profits, now you'll notice that for the 15-month period, I gave you 45,000. For the year end, I gave you 60,000. Now that 60,000 was the same as when we chose April as our accounting date. And all I've done with this one, we made £45,000 for what was a period of 15 months through to the 31st of March. 15 months, 45,000, we were basically making profits at an average of 3,000 a month. And all I did was to change it in this next example to a 16-month period in which we made 48,000. So I've kept that average of 3,000 a month. Before then, the first full year end, that was a £60,000 figure. So I've done that to keep it here in sort of equilibrium, to give you a practical situation. Obviously, if you trade on from 31st of March to 30th of April, it's an extra month of profit. I've just made it the same average profit level. But with these numbers, I want you now to look at the outcomes in terms of the assessments for the years, look at the situation, and actually give advice as regards, okay then, so what accounting date would you choose? You've got the choice, 31st of March or 30th of April. We've worked the assessments. Look back in your notes, look at those assessments, compare them. You know what's happened in terms of the basis periods and any overlap that would arise. And I want you to consider what you might recommend here to your client. Now, you've got a 50-50 chance here. It's either the 31st of March or the 30th of April. But I want you to look at the outcomes that we have determined, make a decision with a reason for that decision, and then we'll discuss it. So take a little pause at this point in time. Think about it. Don't just wind it on and let's see what the answer is. You think about it. See whether you can come up with a reason for choosing one or the other. There are reasons for each. Some of you may go with a reason that is a perfectly good reason, but it's not as good as the reason for the other choice. Let's see what you come up with. So here, a little bit of planning, a little bit of advice to a client rather than that's what the client's done, let's pick up the pieces after the event. And that, of course, is much more what you'll go on to do, if you choose to go on to do it, at the advanced taxation paper, when it's much more about advice tax planning than it is here, where it is mostly computational, apart from those little tax planning style questions that have now started to creep in, usually the 10-mark question in section C. So have a think about it and then come back and we'll talk it through. Okay, so let's see what you've come up with there and the reason for it. Now, a lot of students think in this situation that the problem with choosing the 30th of April is that we've got this great big overlap profit, some £33,000 worth of overlap profit there as we have computed. And that's not going to be credited back until the final tax year. And that could be at any point in the future. Who knows when in the future you will cease trading, and you don't get the crediting back of that until a later point in time. So we've been assessed twice in relation to a figure of profit in the opening years. That doesn't sound good. And then we don't get it credited back until the final tax year. So that is often viewed as a reason, therefore, for I don't want overlap profits. 31st of March means there's no overlap profit, so I'll choose the 31st of March. Now that, as I said, is a reason for choosing 31st of March, but 31st of March is not the choice to make in this example with these numbers. It sort of narrows it down, doesn't it? 30th of April is the one to choose. Because although, yes, you have to wait until the tax year of cessation before you credit back that overlap relief, the issue is about now. The issue about now is, what are you going to be assessed on in those opening tax years? So what I've done here is just list out, as far as the information provided within those questions allowed you to do, what the assessments would be in each of those tax years. And because I'd given you numbers that equated 45,000 for a 15-month period, 48,000 for a 16-month period, it meant that when you looked at the 1920 tax year, there was no difference, whether you chose March or whether you chose April. If, by the way, you haven't already discovered these figures and listed them out, or just identified what they are, go back and make sure you understand where these come from. So there's no difference. 2021, the second tax year, again, no difference. Whichever accounting date you choose, it's going to be 36,000. Now, here is your critical issue. If you choose 31st of March, then you advance to the £60,000 profit. The year ended 31st of March to be assessed in 21-22 was the year ended 31st of March 22. Whereas, if you went with 30th of April, although again you ended up with some 11 months worth of overlap, look at what you're overlapping on. The profit made in the opening period is being made at a lower rate than in the second period. So what happens in that third tax year? You again use that opening 16-month period of profit, in which basically you were making profits, as we've said, at a rate of £3,000 a month, rather than advancing to the £60,000 profit, where on a 12-month period, it was being made at a rate of £5,000 a month. So we've managed to get an assessment of £36,000 in that 21-22 tax year, rather than £60,000. Now you just think, that's £24,000 extra profit being assessed in the 21-22 tax year if you chose the 31st of March. If you choose the 30th of April, 36,000, that's £24,000 less profit. Now, we don't know what other income the taxpayer has, but depending what, if any, other income the taxpayer has, there may be a significant part of that £24,000 of profit that if it were assessed rather than not assessed, it may very well be assessed at a higher rate of tax, 40%. And 40% on 24,000 Well, there you're talking about £9,600 extra tax. Even if it was half of that, it can't all be at 20%, but a mix of that might be slightly less. But it's a big number that we're talking about. And it's not the only number. We don't know it yet. In our introductory lectures, however, we mentioned about national insurance contributions. And if you're self-employed, they are based on, the main one anyway, Class 4 NICs, are based on the tax-adjusted trading profit. So that would be the figure for 21-22, if again you chose 31st of March, whereas the lower figure, lower for income tax, lower for Class 4 NICs. There is an immediate and very significant tax advantage in being assessed on that much lower figure of £36,000. Now you might be saying, but what then happens in the next year and beyond? Now we know that it's the £60,000 that is assessed in 22-23. That, you'll remember, was, I'll just look back to it here, in 22-23, the year ended 30th of April 22. If we had gone forward to 22-23 with the March date, then that would have been, what would have gone in here, that would have been the year ended 31st of March. What 31st of March ends in that tax year? 23. Year ended March 23 rather than with the April date, the year ended 30th of April 22. That is a much older period, the year to 30th of April 22 rather than the year to 31st of March 23. So what that is showing you is if, as is the case here, and is so often the case with new businesses, profits rise over those opening years, then if you choose 30th of April, you will be assessed in any one tax year, whichever from the third year onwards, you will be assessed on an older profit. Remember, that 60,000, that of course was the year ended 31st of March 22, whereas the 36,000 here was the 12 months to the 30th of April 21. You can check those basis periods with the answers in front of you from these earlier examples. So the reality is here, if profits are rising in opening years, by choosing 30th of April in any one tax year, you are being assessed on an older profit. If profits are rising, older is smaller. Therefore, it isn't just a one-off situation here in this particular tax year 21-22. If that March 23, the profits have gone up again from £60,000 to whatever, and profits rise, there is a continuous benefit of using the 30th of April date. So, as a quick rule of thumb here, in terms of choosing that accounting date, if profits are rising over the opening periods, choose the 30th of April. If profits are high and then go down in those opening periods, then you do not want to keep on being assessed over 1, 2, 3 tax years on the same first profit figure, because that's bigger. Therefore, you would choose 31st of March. Profits rising, choose 30th of April. Profits reducing, choose 31st of March, therefore. Okay, now, you probably won't get that exercise, but we do have these tax planning exercises put before you, so it's possible that you might see that situation in a question, a 10-mark question in section C. So, again, hopefully you've understood that, but what you simply must know is what are the bases of assessment that apply in those opening years. We'll call this lecture a day at this particular point in time. Next lecture, we will look to begin with at what is the situation in closing years. Don't worry, very much easier, very much quicker to deal with. One simple 3-step rule, as we will see, to be able to deal with cessation. After that, something we've dealt with before, capital allowances. How do we deal with opening years? How do we deal with closing years in terms of capital allowance computations? We actually already know the answer to that, but I'll remind you of that. All of that awaiting us next time.